Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to use. There always seems to be something on the horizon that could move the markets, and there are several potential big market movers that investors will now have to analyze. Leading chip maker Nvidia is reporting its earnings. The latest inflation numbers are being released. The new Fed chair speaks, and action by the Treasury Department in the bond market. My panel of financial advisors and experts have their opinions on how the market and your portfolio could be affected. Their opinions are coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Kerry Coghill of Coghill Investment Strategies. Also, we find Frank Rossetti. Frank has his own alternative management company, HF Management Company. Joining us at the table also is Kim Forrest of Boca Capital Partners, and we also find Michael Godwin of Fergasso Financial Advisors. Michael is the Chief Investment Officer for Fergasso. Thanks again for joining us for the Bull, the Bear, and You. Perhaps I have been staring at charts just a little too long, but it appears the volatility on Wall Street has declined. Yes, the S&P 500 did set new all-time closing high last week, and since the last time we met. And yes, since the last time we met, the major indices have lost 2 1/3 to maybe 1% of their value. But for the last 2 weeks, the range for the high to the low in the S&P 500 has only been around 40 points. It's August, so maybe that may explain it. However, things could change this week. Once again, there is anticipation about Nvidia's earnings report, which will be revealed on Wednesday. So whatever Nvidia's earnings report might move the indices, will it have an impact on the rest of the stock market, on your portfolio? And that's not all. The inflation data the Fed likes to use will be reported on Wednesday. So I will ask, let's start with Michael here. Will either of these two events have an impact on how one should be looking at their portfolios?
Yes.
Thank you. We'll move on.
All right, so I'll try to be brief and let everybody else chime in. So Nvidia, one of the two biggest companies in the world. It is the bellwether for the artificial intelligence trade. So they do have an outsized impact on what's going to happen in the market based on their earnings. I think the entire market trade this year and going forward is still centered around artificial intelligence and where that might be leading and going. So since they are the biggest company in that field, they're going to matter to the markets. The inflation data coming out, I mean, there's been a lot said about the bond market over the past couple of weeks. Inflation is a key dynamic of that, it's, in conjunction with how much we have sort of on the debt books. So I think the markets will, certainly the bond market will be paying attention to the inflation data. The stock market has sort of kind of looked through everything that's going on with yields and with inflation for the most part. But it is, I think, going to be an important component to see where inflation is heading as we progress into 2026.
I agree with Michael, but I'm going to add another event that you should keep your eye on. Nvidia is super important, but it almost doesn't matter what they report. Sorry. They've probably sold out of everything that they have. What we're looking for is information on the medium term, and that's maybe next year at this time and beyond, about what their ability to meet demand looks like and the new products. But also, there's a lot, and there was a big Wall Street Journal article today about the off-sheet and on-sheet balance sheet items that are Nvidia funding customers. Always a dangerous thing to do. Letting other people talk here for a minute. In a minute, I'm looking at the Kevin Warsh speech this week too, and I am really kind of riveted on what he's going to say. He's not getting great marks from the outset, but I will tell you this. I think he's putting his money where his mouth is. He believes in markets and is letting them float as opposed to trying to manage them. And this is the bond market is what I'm talking about. So I am really looking forward to this speech. Will it have an effect on stocks in the long run? Yes. In the short run, who knows?
Yeah, I mean, it's an interesting week. There are a lot of very, very interesting things going on. I know we'll talk a little bit more about the bond market later in this program, so I won't jump ahead. But it's interesting, Nvidia being the size that they are and, really kind of being a bellwether. If you look at the performance in the space, they're the worst of the group so far this year. It's been all the other ones that have really, really outperformed. So I think that, as Kim said, what we're really looking for from this earnings report is, as with most companies, we're looking for the guidance. We're looking for where they see things. We're looking for any possible changes in demand, because that's going to have a greater impact on the sector. So, yeah, it's a big event, but at the end of the day, it's not, I don't think, it's going to tremendously move the entire market. It might have impact on the sector. Much bigger than that is the inflation report. And when we look at where bond pricing is and where interest rates are, it's a cycle. If we get a hot inflation number, that will have more impact on the broader market than one earnings report. And when we look at the sector of technology and we look at interest rates, there's a relationship there too. So we really want to see, what that data looks like right now and what the inputs are, right? Is it, what is it that's causing the inflation? Where are we seeing the inflation?
Okay.
When I look at the inflation numbers, since Carrie kind of led me there, I find it hard to believe that we're not going to have some level of elevated inflation. I mean, we're borrowing a lot of money to build these data. The government's borrowing a lot of money to run their daily operation. The government's borrowing a lot of money to replace weapons. The component industry for the data centers are borrowing a lot of money to expand capacity to build the components. The defense industry is going to borrow money to expand capacity to replenish the warehouse, if you will. There's just a lot of money going to go in the system, and as Kim has told us many times, when money supply grows, which is what happens when you borrow all this money, and it doesn't matter whether it's wars, buying bonds, trying to manipulate the market and keep interest rates from rising, or that money has to come from somebody, somewhere. Is he printing it? Is he just borrowing it? Or both? And probably both. And consequently, more money means more demand, which means higher prices, because we have supply capacity constraints worldwide. And when the supply can't meet demand, prices rise. It happens all the time. It's economics 101. And so I can't see how anything he says or does is going to slow that down unless everybody quits spending money. Which is not worth it.
I also want to add, I won't mention the company, but something that we haven't talked about in a while, which is private credit. Same thing, it's debt, right? Like borrowing money, but where are you borrowing it from? There was a company that went out to the private credit markets, I think this week, to raise $500 million. They ended up raising
$500 billion or
$500 million.
Oh, okay.
And they ended up raising 1.1 billion. So the appetite in the private markets is great. People are just loaning money to these companies, and what's scary about it is that these private credit companies use leverage to be able to give the money. So there are debt bubbles building underlying in this economy that we really need to pay attention to.
And being in the alternative asset space, transparency is basically non-existent in that world, and you just don't have any idea how much collectively is being borrowed and how it's being used and if it's being used and how profitable the borrowers are short term, which when you're borrowing money, the short term matters. Unless you borrow enough money to carry the debt, which is just beyond belief to me that you would do that.
Well, who's loaning this money to these private equity
People,
firms?
wealthy people.
Institutions.
Yeah.
Okay.
And
Thanks.
now they're talking about opening this type of stuff up to 401ks, which is
Yeah.
totally beyond my capacity to believe that we're going to actually do that. Because most 401k people should not even be thinking about this kind of stuff, let alone doing it.
Well,
And that's,
go ahead.
I was going to say, you know, the bigger question here is how do all of these underlying concerns impact the individual investor? And when you have things like debt and, you know, interest rates and the value of the dollar, all these things, what it really speaks to is for individual investors to make sure that they own quality, to make sure that if they're buying or they're owning bonds, they're owning high quality bonds. If they're owning stocks, they're owning high quality stocks. That over the long term, at least for our clients who are trying to create consistent returns out of a very inconsistent market, going back to the basics and just owning quality, staying disciplined, not being emotional, those are all things that individual investors really should pay attention to.
Michael, I want to bring you back in. You have not had a chance to comment at all about the wash. I guess what Jackson Hole comments that are coming up on Friday.
No, I mean, again, I think Kim and Kerry both pointed it out that it's what he's going. He's obviously trying to be much less verbose than his prior his predecessors, which I don't really have too much of a problem with that. It'd be nice to get back to a time when we don't really care what the Federal Reserve is saying or doing. But it's also, Kim pointed out that he's trying to let the markets do the heavy lifting and the bidding for him, which is great. I think that's how it should be and is supposed to be. Obviously, other government officials have weighed in and are trying to force the market's hand, with Scott Besson trying to buy a bunch of treasuries to force interest rates lower. But yeah, I think from a market standpoint, Kerry pointed out that it's a big deal. I still think that the market, at least the stock market, continues to look past what's happening on inflation. And I don't know, I used to think inflation was trending down. I kind of think we might still be trending a little bit lower, at least, if you X out energy and food, which, the core prices, but it's the trajectory of inflation is super important to everything that's going on in the bond market, which in theory, it matters to the stock market.
Yeah, I want to get to the bond market in just a second, but I do have to ask this question about Nvidia. I think, Kerry, you pointed out, I think it was you, Kerry, that Nvidia's returns are not the right word or not, but they rank the lowest among some of these companies. Could it just be that they've priced themselves to a certain level and people aren't willing to go much higher than that with them?
I'll let Kim answer that.
I think the answer is no. No to that. They're actually going to announce a price increase in their products in this tomorrow. And it's pretty transparent that that's what's going to happen. What I think we're seeing is Wall Street rewards growth. And some of the companies that had not participated before this year, like, I know this is going to be an eye roll, Intel, remember them? They actually sold more product than people were, and they were amazed by it. And a lot of that did go into some sort of AI application. So companies that had before not participated are catching up to Nvidia. And Nvidia, if you remember, and I think the big chase began in 23, 24 was the year of Nvidia. And then 25, things settled down about halfway through. The law of large numbers caught up with Nvidia, where it couldn't surprise people and say, hey, we sold not as much as we said we were going to last quarter, but twice as much as we said. So that kind of surprise died down. And momentum people, in a lot of ways, are few in the markets. Like, there's very few momentum investors, but they tend to drive the performance of these kind of hot stocks. So Nvidia has been dropped by the performance, or by the momentum junkie kind of investors. And it's just kind of treaded water as everything else has come up to it. But it's still
Okay.
kind of the sun in the solar system of AI.
All right. That answers the question. Thank you. All of you have touched on this. I want to bring it up. This past week, there was a lot of focus on the bond market, the Treasury Department, and the value of the dollar. So can you explain, Frank, briefly, if possible, what is happening with bonds and the action that the Treasury Secretary took, and what would be the effect on most people's portfolios, if any?
Well, most people have an allocation that includes some bonds as a defensive device, as a balancing mechanism in their overall portfolio. Consequently, when interest rates rise, as they have been doing, and we're not talking about the overnight rate, we're talking about the market rates, they've been rising, that means the value of those bonds have been going down. So, I mean, it's not as crazy as it was in the 70s and early 80s, but it's still happening. And consequently, portfolios have been negatively impacted by the bond portfolios if they own traditional bonds. Now, we've all talked about alternatives to that when interest rates are low, because we've all talked about the risk of the bond market because interest rates were low in prior shows. So if people listen to the people on this panel, they own things that are probably less impacted by the fact that interest rates have risen. Probably impacted some, but less, at least. And consequently, there's ways to manage around this. And what's happening now is interest rates, which I like to say is the price of money, because the demand for money is so high, which I touched on earlier, the price is going up just like everything else. So the only way you get it going down is print more of it, which causes the dollar to get weak. And which, when the dollar gets weak, that means that foreign products, which are 10 or 15% of our economy, will cost more dollars to buy, which is inflationary. So there's this daisy chain going on around here that you know, it's like it's loop, and we're in it, and hopefully it won't spiral out of control, but the risk lies there.
I think the narrative is somewhat simple as well. I mean, there's a few things that are impacting the markets today. One, you saw the headline numbers come out last week. We have $40 trillion in debt. We're now paying $1 trillion a year in just interest expense alone. But economic growth is still pretty solid. I mean, really aided by artificial intelligence and that boom. Inflation's still elevated. And when you compact all these things, very high levels of debt, pretty elevated inflation, and growth, which is pretty good, investors are just demanding a higher interest rate to hold some of these longer term bonds. And the fact that the 30-year Treasury just hit its highest point in about 20 years, I think is all just the reasons why it's making the news. I don't think it's really out of the ordinary or out of the realm of expectations that 30-year Treasuries should be where they are right now. But it's going to impact the markets because, one, borrowing costs are higher. So all these companies that are building out their AI, ecosystem, they're going to, maybe charge a little bit more money for the products that they build and offer and whatnot. So all these sort of things could, in theory, exacerbate the sort of quote-unquote problem we're having with higher interest rates as all this progresses.
I'm an equity-focused person, so I look at only one. Everything I say, by the way, is hyperbole right now, okay? Other than I am an equity-focused person. I only look at one interest rate, and that every single day, and that's the 10-year. And why do I look at that? It's because that is what everybody else in my area is using to discount cash flows back to see what a company is worth. Here's the oxymoron. As the interest rate rises of the 10-year, you can expect your equities to be worth a little less because that's the divisor. It's just math. So a lower interest rate will allow for a higher multiple. And a higher interest rate is a lower multiple. So that's what I'm focused on. And the longer rates have really been affected, but so has the 10-year. And I'm a little on the worried side. I don't really like it to go above 5 right now. So I'm very much concerned about interest rates for non-obvious reasons.
Well, there's a lot to unpack here. And I will say that, what is going on right now with interest rates and with Besson's intervention, I'm not a fan of it. I think it's very dangerous. I think that Warsh is trying to do what he should be doing, which is letting the markets figure this out. And to have intervention like we're having right now at a time when we don't have a crisis, to me is very problematic. It really is, utilizing something that really should be reserved for a situation where we're in crisis. If you go back and look at this relationship between, between the Federal Reserve and the Treasury, right? You can go back to around 1951, the Korean War, and you had basically a fight between the two. It was kind of intervention at a time when it actually caused the Federal Reserve to become more independent because of what was going on during that time. So when we look at markets and how markets function, and to have something like this be pulling down longer term interest rates at a time where the Federal Reserve is trying to head off inflation, it's not a good thing. And there are so many other underlying factors here in terms of, issuing 2 years to buy 30 years, and it's just causing overall a lot of uncertainty in terms of the tools that the Federal Reserve has and needs to be able to fight inflation. So I'm not a fan of it. I think it's going to be very interesting this week to see what Warsh's comments are, specifically around this topic. So, for investors, bonds are have always been an important part of the portfolio. Yes, they're trending slightly negative for the year, even given the rise that we've seen in rates. So when we look at the last 2 years, we've had positive returns in bonds. We're not overreacting to what's going on in the bond market and saying, let's not own bonds because of this intervention. I think you have to take that as information, take the information that we're getting on inflation, and really understand, okay, what kind of bonds do I want to own? Again, high quality makes the most sense, but it's more so where you're going to be on the yield curve. Are you going to be long? Are you going to be intermediate? Is there an opportunity right now in long-term bonds? If we have a cooling inflation number and we have the Treasury out buying, bonds, is there an opportunity in longer dated bonds? So those are the types of things that, as an investor investing in the bond market, become really important into securing and understanding how to optimize your overall portfolio. Going back to this war situation, when you have a Federal Reserve that is data dependent, how can you give guidance until you have the data? I mean, I was never a fan of all of the transparency that the Federal Reserve wanted to give over the last decade. I preferred, we've talked about this before, I preferred the briefcase method method that Alan Greenspan had. If it was big, it meant rates were going to change. If it was, something like that.
Yes.
So I think we all need to just kind of calm down and pay attention to the data, because that is what's driving the Fed.
Interesting, though, Carrie, you said you're going to be very interested to hear what Kevin Warsh has to say. Given his track record so far, he may not say much of anything about it.
Yeah, and I respect that. I respect that.
Yeah, so do I. I
Oh.
expect to say, okay, those were a lot of words there. What did he say?
Yeah, exactly.
Tipping his hand. He's a poker player. He's not a speaker.
Yeah.
So you raised an interesting point. I'll throw this one out. It's not a good idea because you don't know where interest rates are really headed to just buy the shorter term bonds.
Well, it depends. You really have to look at those inflation numbers to see what direction. That's really what we're trying to gauge when we're looking at where we want to be on the duration side. So, if we felt that short-term rates were going to go up because of inflation, it wouldn't be the best place to be potentially. But, the markets are a little bit smarter than this, as, Kim has said over and over. They're not really concerned about what's going to happen next month. They're really concerned about what's going to happen next year at this time. So trying to play it out.
I'll have to ask this question too, since we brought up people who have 401ks, and I like to talk about them because it's beginning to be better for 401k plans with companies that you have a little bit more control of what you can do with that with your funds in there. Are the bond funds still doing well, or are they faltering a little bit because of the higher rates of higher yields but lower price?
Yeah, they've given back a little. We looked at when we're looking at performance in bond funds this year. Depending on what fund, right?
Yep.
They're all very different. But just kind of an intermediate term, higher quality bond fund might be down 1% or 2% for the year. But that's when you asset allocate, right? You've got, let's call your 60-40 mix. Well, guess what? Your 60% is done really well. And the bonds are there more so for protection. And if we do get into a situation where, we go into a recession, well, when we go into a recession, generally the Fed lowers interest rates and those bonds have the ability to perform well. There have been periods of time where stocks and bonds don't do well. That's why we worry about stagflation, because that's generally a time. I don't see that happening because growth, you can't underestimate the power of AI and the productivity that is happening, and it's happening fast. If someone wants to start a business today, I have a friend starting a business, went into chat, said, write me a business plan. Not only did it write the business plan, it gave the timeline. So their ability to start this business and have it happen in a very condensed period of time is, beyond what anyone could have ever done in the past. So, there is a lot to be positive about. I think that my biggest concern, and actually to Frank's point about you have interest rates going up and what's going on with the debt and the value of the dollar going down. Yes, it makes foreign goods more expensive, but it also makes U.S. goods more attractive. So there's a whole conspiracy theory there too, right? Hey, let's devalue the currency so that we can sell more products overseas. So, I think all in all, you just have to take all the information in and not be emotional and own good quality.
Goes back to owning good quality. Michael, you want to wrap this session up for us today?
The only thing I want to point out on Carrie's comment about bond funds and the return and whatnot is whenever you purchase a bond fund, the most important predictor of what you're going to get out of that fund over the next 5 to 10 years is your starting yield. So today, you can buy a bond fund, high quality, as Carrie was talking about, and probably get around maybe like an average yield of, call it 5.2% or something like that. That is an incredibly good gauge of what you will earn over the next 7 years or so. So maybe the next year interest rates continue to go up, you might be flat like you are this year or not making much money. But if you hold on to it for the next 5 to 7 years or so, that 5.25% is a pretty good barometer of what you're likely to make on an annualized basis over that time frame. So with yields backing up and getting higher, bonds are starting to look a little bit more attractive if you are a longer term investor.
Which is what all of you advocate anyway.
That's correct. And let me put a plug in for the 3 other people on this show and everybody who's listening or watching's advisor. Carrie has said multiple times today, keep your emotions under control. That is Carrie, Kim, and Michael's biggest job today, is keep people off the ledge because they're worried about something. All right, and we haven't even had a correction in the market. And we're overdue for a correction. Just a standard old run-of-the-mill 10-12% pullback in the market, which isn't any big deal.
Yeah.
It hasn't. When's the last? I think that happened when he attacked Iran. Maybe it got close. I don't think it quite made it, but it was close.
And I need to add this because it's really important. This is our last recording before September. Trade volumes have been extremely low. September is the most volatile month of the year. So what Frank just said is really important. I would expect more volatility coming in the month of September. So, this is where you really need to keep your emotions under control.
And
Glad
if
you
you're
said that.
feeling fear,
Go ahead, Kim.
think about greed instead. Are things on sale? That's what you want to think of in a volatile time period. Are things on sale? If the answer is yes, buy them.
Good point. All right. Thank you all once again for joining us. A great discussion today about the economy and investing, and we'll continue our look at investing in the economy in the future editions. And since you're watching or listening to this particular podcast, I ask that you hit the like or the subscribe button. Right now, that does it. We'll be back again in about 2 weeks or so when the volatility picks up and after Labor Day. So thanks for joining us, and we'll see you again for the next edition of The Bull, the Bear, and You.